$50,000 split across 5 Vanguard index funds compounds to $169,000 over 25 years at a 5% annual return. That same $50,000 grows to $342,000 at 8%. Same starting capital, same time horizon. The only variable is which mix of funds you choose and what the market delivers during those 2.5 decades. The gap between those two outcomes is $173,000. That's not a rounding error. That's the difference between a comfortable retirement and a significantly larger nest egg that could fund healthcare, travel, or wealth you pass to the next generation. The question I wanted to answer is straightforward. Which 5 Vanguard funds give you the best shot at landing closer to that higher end of the range? And what does the allocation actually look like if you're trying to balance growth with some protection against the inevitable market crashes that will happen during a retirement-length time horizon? Let me walk through how I framed this analysis. I'm assuming you're starting with $50,000 today. Maybe it's a rollover IRA from a previous employer. Maybe it's an inheritance. Maybe it's a lump sum you've been saving for years, and you finally have enough to make a meaningful long-term investment. You're looking at a 25-year window. That's roughly the timeline if you're in your early 40s now and planning to retire around 67. You're not adding monthly contributions in this model. We're isolating what happens to that initial $50,000 under different return assumptions and fund choices. This is about lump sum investing and the power of compounding when you give it enough time to work. The 5 to 8% range isn't something I pulled out of thin air. Historically, a 100% equity portfolio in something like the S&P 500 has delivered around 10% annualized over very long periods. But that includes some wild decades. It assumes you reinvest every dividend. It assumes you never panic sell during crashes when your account is down 30 or 40% and financial media is screaming about recession. A more conservative 60-40 or 70-30 stock-bond mix, which is what a lot of people actually hold as they age, tends to land closer to 6 to 8%. I'm using 5% as the lower bound to account for several possibilities. Maybe we hit a lost decade where stocks go sideways. Maybe valuations are elevated today, and future returns will be lower than the past century's average. Maybe you tilt more heavily toward bonds as you get older, and that drags down your overall return. 5% is conservative but realistic. 8% represents a scenario where equities do roughly what they've done historically, and you stay mostly in stocks. It's not optimistic. It's just in line with what broad equity indexes have delivered when you give them multiple decades and don't try to time the market. The difference between 5 and 8% doesn't sound dramatic when you say it out loud. 3 percentage points. But over 25 years, those 3 points compound into an extra $173,000. That's the entire point of this exercise. Small differences in annual return become massive differences in final wealth when time does its work. So here's the model. I picked 5 Vanguard index funds that cover the core building blocks of a diversified portfolio. US large cap, US small cap, international developed markets, emerging markets, bonds. These aren't exotic picks. They're the same funds that show up in millions of retirement accounts. I weighted them based on a growth-oriented but not reckless allocation. Then I ran the compounding math at both ends of that return range to see what the outcome looks like in both the conservative scenario and the historically normal scenario. Here's the mix I used and why each piece is in there. Vanguard Total, stock market index fund, gets a 40% allocation. That's $20,000 of your $50,000. This is the backbone of the portfolio. It holds the entire US stock market. Large cap, mid cap, small cap, growth, value, all of it. Over 3,000 companies. Historically, broad US equity has been the primary engine of long-term wealth creation for American investors. I'm giving this the largest slice because if you're a US-based investor with a 25-year horizon, you want the bulk of your money in the asset class that has the longest track record of compounding through recessions, inflation cycles, rate hikes, wars, pandemics, and political chaos. This fund's expense ratio sits around 0.03 to 0.04%. That means fees are almost irrelevant over time. You're keeping nearly every dollar of return the market generates. Vanguard Total International Stock Index Fund gets a 20% allocation. That's $10,000. By the time it feels safe, the recovery is already halfway done and you've missed the snapback. Staying invested when it feels worst is the behavior that separates the 8% outcome from the 5% outcome. Keeping fees low is the fourth factor, and it's the easiest one to control. Vanguard's index funds charge 0.03 to 0.15% in expense ratios. Over 25 years, that's almost nothing. If you were instead paying 1% annually in fees, which is common in actively managed funds or high-fee 401k plans, that 1% drag would cost you tens of thousands of dollars in lost compounding. A 1% fee doesn't sound like much, but it's 1% of your total balance every single year. On a $300,000 portfolio, that's $3,000 a year going to fees instead of compounding. Over 25 years, the difference between a 0.04% expense ratio and a 1% expense ratio is enormous. Low fees are a structural advantage you lock in on day one. You don't have to do anything except choose low-cost index funds. That decision alone is worth more than any stock-picking skill or market timing attempt. Now the other side. What drags you closer to 5% instead of 8%? What are the risks and conditions that push your final number toward the lower end of the range? Starting from elevated valuations is the first risk. Right now, by measures like the Shiller-Cape ratio, US stocks are trading above their historical average. That doesn't mean a crash is imminent. Valuations can stay elevated for years, but it does mean future returns could be lower than the past century's average, especially over the next decade. If we're starting from a high base, mean reversion could shave a couple percentage points off annualized returns. When stocks are expensive, future returns tend to be lower. When they're cheap, future returns tend to be higher. You can't control where valuations are when you invest. But you should understand that starting today, with valuations above average, might mean the next 25 years look more like the 5 to 7% range than the 8 to 10% range. A lost decade early in the 25-year window is the second risk. If the first 10 years deliver flat or negative returns, like the 2000 to 2009 period in the US, you lose a decade of compounding at the front end. Even a strong recovery in years 11 through 25 won't fully make up for it. Sequence of returns matters. If you get great returns in the first decade and mediocre returns in the last decade, you end up with more money than if that sequence is reversed. That's because the great returns in the early years compound over a longer period. You can't control this. But it's why some people who invest at the wrong time end up with disappointing results, even if they do everything else right. If you invest $50,000 right before a lost decade, your outcome will be closer to 5%, even if the second half of the period is strong. Rising interest rates crushing bond returns is the third risk. If rates keep climbing, bond prices fall. The bond portion of your portfolio could deliver near zero or even negative real returns for years. That 15% bond allocation is there for stability, but it's also a drag on total return if rates stay elevated and inflation eats away at bond income. Bonds are not risk-free. They have interest rate risk and inflation risk. In a high-rate, high-inflation environment, bonds can lose purchasing power even if they don't lose nominal value. This is one reason why some investors skip bonds entirely when they have a long time horizon. The trade-off is more volatility, but higher expected returns. International and emerging markets underperforming is the fourth risk. If the next 25 years look like the last 15, where US stocks crushed international, then the 30% you have in international and emerging markets will be a performance anchor. Diversification is insurance, not a guarantee of higher returns. You're spreading your bets so that if one region underperforms, another might pick up the slack. But if US stocks continue to dominate and international continues to lag, that 30% allocation will cost you relative to going 100% US. You won't know which region will win over the next 25 years until it's over. That's why you diversify. But diversification sometimes means accepting lower returns in exchange for lower risk of catastrophic underperformance in any one region. Here's what I take away from this exercise. The difference between 169,000 and 342,000 isn't luck. It's the compounding effect of a few percentage points of extra return sustained over decades. You get those extra points by staying in equities when it's uncomfortable, reinvesting dividends, keeping fees near zero, and not bailing out during bear markets. The 5-fund mix I outlined is one way to balance growth and diversification over a 25-year horizon. It's not the only way. If you're more risk-averse, you'd tilt more toward bonds. If you're more aggressive, you'd cut bonds entirely and add more small-cap or emerging markets. The point is that the structure matters less than the discipline. Picking a reasonable allocation and holding it through multiple market cycles is what separates the people who reach the higher end of the range from the people who don't. If this breakdown was useful, subscribe. I'll keep running the numbers on what actually works for long-term wealth building, not what sounds exciting in a headline. Next video, I'm looking at what happens when you add monthly contributions on top of that initial lump sum, and how dollar cost averaging changes the outcome when you're building wealth over time instead of investing everything at once.